Hello, my name is Isma from FXKAMPALA. Let me take this youth opportunity. Thank you all of you for liking, commenting and sharing our particular videos. Hope they actually help you out. Well, there have been quite a number of there's been quite a number of people that have actually asked me things to do with the commodities. That is actually something to do with how to trade gold, how to trade oil. Now, in this video, we're going to have a strategy showing you clearly of how you can definitely trade based upon oil. Okay, some people actually call it crude oil, other people actually call it WTI. So we're going to look at oil, but then before we actually start, we can start definitely see how we can probably trade oil. There are certain things that we should actually have in place. We all know that oil is one of the world's basic necessity among all other things. Okay, it's actually needed to run a couple of things. It actually is the one that runs the factories. It's the one that actually runs the cars, the companies, the plants, the ships, and so on and so forth. But then a decline in oil is a nightmare to oil producers, but a dream come true for the oil consumers. Meaning that if actually the prices of oil decline, then we actually see a nightmare to the people that basically produce oil. And it's a dream come true for the users, that is actually the people that have the cars, the people that run the factories, the plants, and forth. So before, we're going to first see who are probably the producers, and then we definitely see who are the consumers. And then in this particular video, based upon the strategy of how you can definitely trade based upon oil, we're going to look at probably two different economies. We're going to look at Japan in particular, and also going to look at Canada. Now, it's at this point we actually see Canada being actually one of probably the 10 big nations that produce or export most of their oil, and then we also see Japan basically being the biggest probably importer of definitely oil. So we see actually Canada probably exporting all its oil, hence probably a producer, and then Japan becomes the consumer. So the hike in price for Canada is actually good, whereas it's actually bad for Japan. Then also the decline in the prices of crude oil is actually working for definitely Japan, and it's actually a nightmare to Canada. So we're going to see how we definitely can trade and have a clear strategy based upon oil when we are trading currencies or when we are trading. We all see that the highest the price of oil or crude oil has gone is about 142 US dollars. That is in 2008. But then before that, there are many actually traders that ask for the magic strategy to trade oil. However, I don't particularly trade oil, okay, in particular because of the volatility it has in the markets. So many traders ask for a magic strategy. I personally don't trade oil in particular because of the volatilities that we actually are associated with oil, okay? But then as discussed above, we have seen that you can definitely trade when the prices of oil goes up, then we see Canada doing well, or that is the Canadian dollar. And then when the prices of actually oil comes down, then we see also the price of Japan increasing, the price of the yen increasing value, because now there will be more people that will definitely buy oil, okay, because of and we actually see people enjoying in Japan because now the prices are low. So it's probably an easier improvisation of actually trading oil is directly could be utilization of the knowledge of oil prices. So what I'll definitely analyze, or what I'll definitely look at when coming up with this particular strategy, or when using this particular strategy, will now be as utilizing the prices of oil. Then after knowing the prices of oil, we definitely analyze the oil in particular as an index or as a commodity in particular. So we analyze it properly because we do not want a lot of volatility in our charts. Then after looking at these prices, so we use this information or the price knowledge of oil, then we use it for our trading the CAD JPY. So we're going to see a couple of things of particularly this strategy, how we use this particular strategy, which time frame is favorable for this strategy, what could definitely which indicators do we use for this strategy, and then a couple of things that we're going to see in this particular video. So like, share and subscribe as we get onto our chart and definitely see how we definitely can trade oil. To our chart, we definitely can all see this is oil and it's actually US oil. It's actually US oil. Like I told you, the differences that we have between CFDs and underlying stocks or underlying commodities. We also saw the differences about probably bonds, features, cryptos and forth. So if you've been watching all our videos, you in particular now to know all the differences that we have. When I definitely say CFDs, then you definitely know what we are actually looking at. So we're actually trading oil or US oil as a CFD. So as we can see properly on our chart, we have it as the US oil, and then sometimes it's called as the WTI or crude oil. So when you look at oil, this is the price, but remember, we are not trading oil for this strategy. We're actually using the oil prices, the knowledge of oil prices, and then replicate these prices to actually be in position to trade the CAD JPY pair. Why? Because now we see Canadian dollar as being the major, the major export for oil, and then we also see Japan as being the major importer of oil. So we are using this particular pair because what literally happens, or any effect that affects the oil prices, it's also going to affect this pair. Fact being that one is a major importer and the other is a major exporter. So this is our chart and this is how actually oil works. So when it comes to this strategy, one, we actually need to first analyze the markets for the oil. So you analyze the markets for the oil. Let's assume now, for instance, when we come onto this pair, this is oil, and definitely, apparently, right now, I'm expecting oil to increase in value. Having broken the previous resistance. So make sure that you actually go to the oil prices, and when prices break above the previous resistance, or when they actually when they actually break below the previous this was the previous support. So when the prices break probably like the way you see here, let me try to maximize as I was actually showing you this. So let's maximize our chart and definitely now can see it properly. So this is what I mean. When prices, for instance, here break the major resistance above and definitely show they are now going up, is actually we are supposed to buy. That's if we are on oil itself, or WTI or crude oil. Then when it actually or probably breaks the support, like what happened probably happened here, after it had broken the support here and hence coming down. So when we see this, meaning that if we are buying the market in oil, then we also definitely have to go to CAD JPY and we buy. If you are selling, then you still also have to actually do the same when oil is actually going to lose value. So what we also do, of course, after making clear analysis, good analysis. So make sure it is losing. When it's losing, you also still go to CAD JPY and sell that particular pair. So when it comes on here now, for instance, for this case now, we're looking forward buying the oil because now we expect oil to increase in value. So what we do now, this is what our projection is, the analysis and the statistics. So we expect slightly oil to come somewhere down to pull back, and then we expect it to keep going up. So when it goes up, we expect now to buy at this particular point. So what we do, we are expected to buy at this particular point, meaning that if we are buying, we also expect now to see the same thing happening on CAD JPY. So what we do, we don't execute trades here, because now apparently for me, I don't trade oil because of the volatility that is attached to oil. So what I do, I actually, like I told you, go to CAD JPY and look at CAD JPY, then execute my trades. But then it's not just a matter of you actually executing trades, okay? There are certain things that should be in place, and there are these things that should be in place that we're going to see when it comes onto CAD. So the reason as to why we come on oil is actually for us to do extensive analysis, intellectual analysis, okay? Then after doing the analysis, then we will have to flip. So before we flip to CAD JPY or to CAD JPY, let me first grab this that we had apparently shown to be used, and then we can actually then flip. So what I'm going to do, I'll first and foremost reduce this, and then I'll actually look for that particular pair, which is CAD JPY. We all know CAD JPY. CAD JPY is an exotic pair, okay? For those that really know some of the things that we've been going through, okay? So we see CAD JPY here. Let me circle it for the guys to see it, for you guys to see. So it is this pair. Then what we do, we click on it, and then when we click on it, it's under our watch list. So when we click on it, it's definitely now brings the chart, okay? It now brings the chart for this particular pair. Now, what you should at least know when we are trading with this strategy works better. One, the currency pair it works better is CAD JPY. Two, the next thing that you're supposed to do is to make sure that you're trading in a daily time frame, okay? Trading in a daily time frame means that you now, each and every candle that appropriately now tends to be on this chart is lasting for a full day. So make sure you use this specifically for a daily chart, meaning that it's probably this strategy works probably best for the guys that are in position to actually keep a lot of time in the markets, or keep have their trades last for quite a number of days in the market. So this is the strategy. This strategy is best for these guys. Oh, you guys, this is your strategy, okay? So make sure you're in a daily time frame, okay? This is a proven strategy, okay? I'm not saying that it works 100%, but it's already a proven strategy, okay? It's a matter of you using it, and it's definitely going to work out for you, especially for the guys that do not want high volatility asset classes, okay? So let me try to maximize. When it comes to CAD JPY, I don't need to do analysis, okay? I don't need to do analysis like I did, okay? I don't need to do analysis. Then the next thing that I'm supposed to do, or let me first also had some missing levels, okay? I need to add some missing levels. That's another strong level. We also see another strong level here. So I also see another strong level here, and then I also see another strong level there, okay? And okay, yes. Then after reaching onto this pair, first and foremost, what I'm supposed to make sure, I should make sure that this particular chart is on a daily chart, okay? Meaning that it's supposed to be on a daily time frame, okay? So now this chart is on a daily time frame. Then we also deploy another instrument to use when we are trading, okay? This instrument is called the average true range, or the ATR, okay? It's called the average true range. The average true range indicator was developed by J. Wells Wider to measure the volatility of the market, okay? Now, when we are using the average true range, it's an instrument, it's an indicator that definitely used to measure the volatility. By volatility, we are actually looking at how probably flexible, how big does the market move from one point to another point, okay? Now, by volatility, we usually see a number of candles. So we need this, we usually see big candles usually that reflect the volatility. So the market will definitely move from one point to another point with the shortest time possible, and then as compared to the others, and the tool that we can use to do this is actually the average true range. Okay, like we said, this tool was developed by J. Wells Wider, okay, that measures the volatility. Okay, now the true range is defined as the large value of the absolute difference between the current high, the current low, the current high and the previous close, the current low and the previous close. So it measures all these aspects. Like we all see, if you definitely don't know where you're supposed to get the average true range, go on your indicators section, or where you can get the indicators, then look for the average true range or the ATR, then make sure that all the parameters are left by the default settings, and then click on it. When you click on it, it will now comes to appear here. So we already have it. It's already in our charts, as we can all see properly. So it actually looks like this, okay, meaning that for it doesn't measure the direction of the market. To some people, they will be like, when the ATR increases in value, some people would assume it's actually taking the market also up. No, the average true range shows increases as probably the market also increases in volatility. Okay, probably the volatility can either be up or it can be down. So it will also appear down, okay, like the way we see here, okay, like the way we actually see here, like the way we see here, it was a downfall, okay, and the ATR instead was increasing value. It was actually showing that there is volatility, because for it will never tell you to which direction the volatility is going. Now it's after you to look at the chart to tell to which direction you expect the volatility to be. Now the volatility this time was down, and for it was showing it's increasing. So even on a downtrend, if you're experiencing a lot of volatility down or up, the average true range for it will show there is an increment in volatility, as we see. So that's the indicator that we use. I think it's the only indicator that we use when we are trading with the average true range. So let me first wrap this. Then after putting your average true range or your ATR on your charts, okay, with the default settings, then we are supposed to execute our buy order, because all the analysis we've done is already done with the oil side or on the oil side. So what we're supposed to do is we're supposed to come and definitely buy here. Okay, so we will actually plan our entry to be at this point. We have just drafted the green line, and then the stop loss is determined by this value here. So you should always make sure that you get the first 2 digits. Okay, like let me show you. Like you come at the reason that's why we need the ATR, because we need these values here. Okay, we need the values here, the ones that are put in the box. So we need those values, especially the ones that are this is the value that is reflected. Let me give it to you here. It shows it's 0.701. okay, so it's the value from the ATR. It's the value from the ATR, okay, which is average true range. Okay, now when we have such values, this is what happens. Okay, so what we usually do, we make sure that our stop loss, okay, for this particular trade, we multiply it times 2, okay, to get the number of pips to use our stop loss. So what we do, we get the first 2 digits, the most 2 immediate digits from the stop loss here, okay, like this one, like 0.70. so we make sure that at least our stop loss is going to be now something to do with now our stop loss is going to be 70. So we said we remove the 0.70 and we call it's actually 70. Okay, that's how we read those values. So we get the 70, we multiply it by 2. So whatsoever value as you have here for the ATR, you're supposed to multiply it by 2, which will actually give you 140 pips. Okay, I believe pips, let me make pips. Okay, so it is the ATR that gives us the stop loss. It actually gives us where we're supposed to place our stop loss. So we get the average true range value. Okay, those are the numbers after the decimal place. Okay, after the decimal point. Okay, that is 70 and 0. If today it's 70 and the next day it's 80, because they actually keep changing. Okay, now we get that and we multiply it by 2. Okay, so meaning that now we'll have to get our stop loss to be at about 140 pips. So we measure and see where we actually have our stop loss as 140 pips. Okay, so meaning that between the entry point and the stop loss, we're having 140 pips, okay, as our stop loss, meaning that 140 is going to be our stop loss. And this strategy works with a risk reward ratio of 1:3, meaning that if you're risking 140, then your take profit should be at about 100, or should be at about 140 times 3. So we multiply our stop loss times 3 to have the take profit. Okay, meaning that, for instance, if I give the stop loss distance here, or this the stop loss to be at 142 as our pips. Okay, then this being our buy point, okay, where we are buying, and then also the take profit will be at about 140. It's actually 140 here. It's 140. Let me wrap this. It's 140. It's 140. 140 pips. 140 pips. Then our take profit is going to be hey Siri, what's 140 times 3?
Times 3 is 420.
That's about 420. So our take profit is going to be, our take profit is now going to be 400. Our take profit is going to be 420 pips. It's going to be 420 pips. Okay, and it's automatically supposed to be up there. Okay, hence the strategy actually giving you both the stop loss and take profit. It's as simple as that. Okay, hope you enjoyed this video. If you really learned, share this video, subscribe, and also follow us on other social media platforms. You can also don't hesitate to comment where you need help. And for more info, for those that really want to learn how to trade, learn how to do all other related financial asset classes, that is things to do with crypto trading and so many other things associated to trading, you can use the contacts below this particular video. And for more info still, you can use the details below this particular video. Thank you for watching. This video. Hope it has been helpful. I have been FXKAMPALA, and I do sign out. Bye bye.